Hello, everyone. Welcome to today's session. Let's get underway here. Um, Market's getting a little crazy here. Let's talk about that first of all. We'll talk about kind of current market conditions and then go in and look at the portfolios and then look at some, pardon me, some of the trade ideas currently. Market conditions bearish, obviously in a bull market. This bull market is coming into question each and every day. We're at a pretty, pardon me, we're at a pretty key support area, and we'll look at that. The short term, we've got price momentum that's accelerating to the downside. We are at kind of that capitulation type location where it's you're starting to see a little bit of fear, a little bit of panic, and potentially some that could create at least a short-term bottom right here. So let's look at some of that activity. We've got this major support area right here, right around this 414, 416 range on S&P 500. We've still got sentiment that's high. We've got momentum that has bounced off the lows, moved higher, and then is now retracing. We do have divergence on momentum and breadth both. We'll talk about that. Divergence is when you have a lower low on price activity, but then you have a higher low on the indicator or the oscillator or whatever it is that you're focused on. Typically, indicators will have some kind of divergence because an indicator is, for the most part, based off of some kind of derivative of the stock itself. It's not the price itself. It's actually, like a moving average or something else where it's calculated off of the price. So it lags, and when that does lag, it can create some divergence like this. And that's one of the things to be watching for, is if you have price that looks like this and making a new low on price, but your indicator looks like this, maybe your indicator goes low and then high and then low, and then this moves higher and then this moves higher. So this is divergence, price activity and oscillator activity, where they're doing something different. That's happening on price on S&P 500 on both breadth and momentum, more so momentum than anything else. That's really the one of the things to be aware of. Momentum, we're in this bearish trend now approaching extreme. With today's move, that'll probably tick over to the extreme range as well. And breadth indicator is extreme. They can get more extreme, obviously, and depends on how the day unfolds. They could close out pretty extreme. We've got sentiment, which is still in this upper range. That typically doesn't market bottoms typically happen. Major market bottoms typically happen when sentiment is low. Market tops happen when sentiment is high. So we could be at an area where this becomes a double-edged sword, whether it's a contrarian indication to say, well, everyone's still complacent, therefore price can move lower, and then everyone starts to freak out, and it starts to move the price lower, and the sentiment starts to drop as well. Versus everybody's still positive. This is just price retracement of an overall uptrend, and we could continue to move higher. We're right at that conjunction right now, and we'll look at that on S&P 500. Buy-sell ratio is extreme. It ticked back down to 0.11. It was 0.13 yesterday, 0.09 a couple of days ago. That can drop to 0.06, 0.05 within this last uptrend. Typically, we'll get to this range right here. I've drawn this out before, where this is about the normal range. It's not a perfect line, but right around this range, even on both up and down markets right here. These are kind of outliers of really significant market bottoms. And so we're right at that upper range where we could see a bounce. We could see that coming back together. We've had this has been a pretty long process. Oftentimes that buy-sell ratio will unfold in three parts. Not always, but most of the time. So we could be on 1, 2, and 3. The formation of it ends up unfolding a little bit different each time. Like kind of here you've got 1, 2, 3. Back here you've got 1, 2, 3. And this is unfolding a little bit more. The more important part of it is where it's at, because even in a worst case scenario, it doesn't have much further to go. It could bump up here, but who knows why the market is selling off right here. And we're at that extreme location. It's at that pressure point, that pain point, and oftentimes that is where we do start to get some buyers that start to step back in. It feels bad, but that's why it happens, is because you start to get panic selling, and then you start to get institutions that start to jump back into the market. We'll see if that happens, or if we're in for some more downside, and if something ugly is actually starting to unfold right here. Let's look at S&P 500, because this is our. I'm going to pull in the 1 year time frame. I'm actually going to go out a little bit more than that, and I'm going to highlight this range right here. And get that next bar in there. So this is really our last year of where we've been at right here. We've got this low, we've got this high. This is our current trend from that low to this high, and now we're working on this retracement. This 382 416 level, that one, that's a pretty significant support area, and we're just slicing through it today like it's nothing. So what I'd like to see is whether or not we do get an end of day rally, kind of a bounce right here. If we do, and we can kind of start to see a little indication of some uptrend, we may close back up above that 416 or that 382 level. If not, then there's a very good chance that we're headed to 403, which is the lower end of that support resistance band. You can see some activity here, a whole bunch of activity here. So there is a pretty significant support level that's coming up around that 408, 405, 403, and we're already at 413. We're only down 1%. It feels a lot worse than that, but it's just not that big of a deal. What makes it feel like a bigger deal is where we've come from all the way back down. Okay, so let's watch to see in the shorter term if we can get a bounce right here and what that ends up looking like. In traditional pattern analysis, we're looking for two things. We're looking for support resistance areas, and so when these start to break down, it stair steps. Now this 416 range is going to create some resistance, and that could roll things back over. So we may get a bounce, but so is this one right here, 433. If we can close back up, maybe bounce, run back up to 430, and then see what happens there. That based on this price pattern where we have these 5 waves down now, that's probably going to be the highest probability move next is a move back up and then a retest of this 433, and then see if things roll back over, or if things really get hairy right here, we could move all the way down to 403 in this current trend over the next few days, and then find that support and bounce back up again. We're now, based on this extreme, my goodness, we're now, it's that winter season starting to creep up on me again. That's kind of our current market conditions. We've got a lot of things that are just way oversold right here. So price activity could drop. We could bounce around here. We could drop another % or 2, but it's so oversold and so extreme that we're due for a rally right here. We're due for a bounce. Whether or not it begins a new uptrend, that's going to be the big question moving forward. One of the things I've talked about, in fact, I think I covered it Tuesday, was focusing on those interest rates, because we're seeing TLT. Let's see what it's doing today. I don't want that full 2 years. Let's go to 6 months. We're actually up 1%. Okay, let me change this perspective here so you can see that this is what we want to see right here. We want to see bonds starting to do this, and let me just double check right there. Yeah, so a little bit of a rally here on bonds, and if we can get kind of a bottoming process, maybe a run back up here, a retest, and then a little pullback, and get this bottoming formation and then a move. This 236 I think is the next target for the bond market. If it can rally, I think equities will pause right here as well and start to move back up. So that's actually a good sign to see bonds up 1.5% today. Let's take a look at the shorter term ones as well, because this is also something that we want to be watching. So here in both cases, we're seeing bonds, the long bond, the short bond, both moving higher, which means interest rates, at least today, and it's not by much, but at least they're not participating in the fear. They're not participating in more downside as equities are coming undone. I think the big issue on S&P 500 is Google and some of these other tech companies that are having some earnings misses, and their guidance is a little bit different. S&P is so heavily weighted now with those companies that they really do move the market. They move the S&P, and it becomes a little bit lopsided, a little bit skewed right here. So on we'll watch to see. Here we're at this 50% just based on this retracement. This November low wasn't the low. That's why I grabbed one out a little bit further right here, because it's oops, let me just refresh that. This low, taking this move from here to here, that really is the low, this October low, but the 1 year time frame is now grabbing the November low. Either way, we're still, this is still right at this support location. Inside of that zone, we're getting a little bit of a move here today. I also use TradingView. TradingView is it's a great charting tool. This is the 1 minute chart on S&P 500. So I've been watching this 1 minute chart to see if we're bouncing off any kind of bottoms. And this is intraday. So we are getting a move intraday, and that 1 hour chart too, just to kind of see, are we getting a pop right here? So that's a decent looking move on the 1 hour chart. What that looks like on the daily chart is, is just a little wick right here. Okay, it's bounced down here, and now it's starting to move back up. If we can get some kind of a hammer type pattern, something like this, that's not a great hammer, but look what happens here. Oftentimes you get selling, aggressive selling, aggressive selling, and then bam, the next day we gap higher, and then bam, the next day we gap higher. We could get some buying right here, and we could really, really easily just take off to the upside. We could get, it could be some short covering rally. Once you get profit taking on the short side, you get all of the selling that's done. You get new market participants that are jumping back in. We're just right there. Within the next day or two or three, we should start to either see a pause or some kind of a move back to the upside. It's got a lot to retest now. It's got to retest that 420. It's got to break up above that, and so it's going to be a little bit of a grind here as we bottom out and start to move back up again. Let's talk about a few stock ideas now. Portfolio, we've primarily been focusing on the new buy daily, NBD, and sell to buy. This has been, it's actually been, it's doing pretty well. We started this on September 1st, kind of right at the market top, and the strategy is adding in a new stock from the new buy list every day, and adding a percentage to that. Now the strategy is 2.5% of your capital per trade. Not if you're stopped out 2.5%, but the position size, the full position size is 2.5%. So if I have a $100,000 portfolio, the most I'm putting into the trade is 2,500. Okay, and then I'm following the signals. I follow a new buy signal. So for example, this was the new buy signal today, and this thing's gone hog wild today. If we go signals, and it even gapped. So in this case, I'm just flat out using the signals, and sometimes you just get surprised. If I were to overthink this, I probably wouldn't have made the trade, because it gapped higher. It gapped like 17% higher, and it was already kind of extreme. But in this case, it's just like I'm just following the process, and this thing's up 16% today, even after a big move yesterday. It could, historically, it could drop just as fast. So a $2,500 position, or let's say you've got a $10,000 account, you're buying $250 worth of this stock. It's smaller position sizes, but it's going to allow you to sleep at night. You're not going to have, you're able to participate in really, high flyers that have this possibility to make big moves like this, but at the same time, it's not, the volatility is not going to affect you nearly as much. We're diversified across multiple holdings, but not that many. Okay, we maybe have 15 open holdings right now. The market has naturally stopped us out of the weak ones, And now we're left with the ones, you can see we're almost, and the ones that are working are starting to really accelerate. We've got HNRG, which is a coal stock. It's kind of been volatile right here, but now in the new buy range in the last 3 or 4 days, we had CIFR, which had a big move. Here was the new buy. It was the top new buy list. It's a crypto mining company, and it's rocketing higher. That one's moving well. And then we've also had INTR, which was the new buy the day before, back here, and it's also starting to accelerate. So the ones that are working, even in the market conditions right now, these last 3 or 4 have done pretty well. SYM not as much from the new buy here, but we'll see. We'll see if it continues higher. And it makes it just a lot less emotional to be able to say this is the process I'm following. Some are going to work, some are not going to work. I don't know which ones are going to work and which ones aren't going to work, but I've managed these kind of portfolios long enough that some of these, and all it takes is 1 or 2 or 3 of these to stick, and they never look back, and they may go up 200 or 300% from here. And you get a handful of stocks that get stopped out at 5, 6, 7, 8%. And then you get a handful of stocks that we just continue to hold on to as long as they're working. And that's a rotational process. It takes rotation for that process to build out the portfolio. And then over time, it's just this natural evolution. Because if you think about what we're doing, every single day in the market conditions, we're adding into what is working that day. And ultimately, the market, the stock market, I think it's getting more and more skewed because of the way that these indices are built out. Like, for example, S&P 500. We say the S&P 500 is the market. Well, look what the market as a whole has been doing as it's continuing to drop. But there are always a handful of stocks that are in there that are not the market. They're different pieces. So what we're kind of doing here is we're building our own market in stocks that are working. And obviously that's not going to work in every single scenario, but we just have to be okay with being okay and with things getting stopped out and not having it be a big deal, and not being like, oh man, I'm such a crappy stock picker, or why did I do that? Or, and when we're trading individually, or we're trading a certain method, or if we're like trying to pick just the right stock and the right system and the right option contract or the right whatever it is, and when we have to try and make that decision, then oftentimes we make, if we get it right, we're happy. If we get it wrong, we're garbage, and we're mad, and we're frustrated, and we're this doesn't work. I got to find something else to do, to trade, or some other method. Or that's just an extremely common feeling and process in any trading methodology. That's a common process. I'm not saying this is better or worse than anything else, but it works, and it allows us to keep emotion out as much as possible. We're going to have volatility. There's no way to not have volatility in any method, but to have the account value and volatility has I think it dropped down to maybe -4%, and now it's starting to move back up. That's the kind of volatility in the vast majority of portfolios that I want to manage. I don't want a ton of risk. I don't want a ton of volatility. Over time, if we can do 20 or 30% on average a year, that's fantastic. Hedge funds barely do that. So if we as individuals can also do that without getting blown up, and without having that one stock that's like, oh my gosh, it dropped 50%, and I put way too much money into it, and now I'm sunk. Now I'm stuck, and it's an unfortunate story. And if you've been doing this for any length of time, you've probably felt that. In my early career, 25 years ago, I think I blew out two full trading accounts, where it was, it was the .com bubble in '98. I started trading Cisco call options, and made just a lot of money, and immediately in 2021 gave it all back again, just because it was all I knew how to do was buy call options. I didn't know how to even do anything bearish. And so you go through a few of those cycles where it's painful, and you learn volatility, and you learn that what will, Murphy's law, what can go wrong will go wrong. And so that's why that's why diversification, essentially was invented a long, long time ago. But we're not overly diversified. We don't have 500 stocks. We've got a handful right now. Less than 50, less than 30 even is entirely manageable and probably the most effective. Now, one of the things we can do as we're let's talk about that. As we move buy sell ratios back to bullish, let's say that this starts to move back here and we get a move that starts to look something like this, and it's starting to become bullish, and then we get a crossover. Remember what that crossover is doing. That crossover right here is now taking our buy sell ratio back up above 1. Okay, anytime it's above 1, it looks like this. Anytime it's less than 1, it looks like this. So this buy sell ratio is going to pop back up above 1. Now, what we could do with that is say, okay, the market now is back in an uptrend, and it's a solid uptrend. And the stocks that are jumping into that new buy list should participate much more strongly. So what we can do to increase our, we can do two things. We can leave our allocation alone. Let me find the right tab. Instead of this being 2.5%, we could bump that up to maybe 3% or 3.5% when we're in an uptrend. We could even have moved this back down if we're in a downtrend and say, I still want to be buying stocks, but I don't want to be buying as many. I want to only be buying 1.5 or 2% allocation. So when we get in more bullish environments, we can bump up the allocation per holding and potentially make a little bit more money in those cases. These stocks that we've been buying, they in uptrends, in when buy sell ratio is positive, they can go bonkers. They can really, we're up 23% in a month or two on this one. Even on these newer ones, you're seeing we're up 15-20% in a matter of days. That's the kind of moves that happen in uptrends. These are a little bit more in downtrends, and we're still able to participate. It's a little bit harder, obviously, because you're getting more and more stocks that are losing. So here, the ones that have been stopped out, the biggest one was 18. And there's been a few, 3, 4, 5, but the whole point of our method is to get rid of the losers quickly and hold on to the winners as long as they keep winning, and then keep rotating. We have one that loses, we jump into a new one. The next one on the list, we add into it. If it's a loser, we get out of it. We jump into the next one. Okay, if it's a loser, we get out of it. We jump to the next one. It's going to be a winner. They're going to go back and forth. And as of this, the market conditions right now are relatively flat. So, these are. I'm optimistic of these last 4 or 5 trades to see what they end up doing. Some of these are kind of fun, kind of exciting to see if we can get a big run up on some of these. And there may be some speculation starting to come back into the market, and this is an indication that maybe that's the case. Yes, that's a crypto stock, and yes, this is, I think, a biomed. Yeah, and those end up being a little bit more volatile, but it's kind of what we want. We want pretty volatile stocks, and we can afford to do that with smaller allocations. I can't afford to do that. If I got $10,000 in that thing and it's jumping around by 10, 15, 20%, that may be way too much for my risk tolerance, and way too much for my account to be able to handle. I want this to be a long-term event. I want to be able to do this long-term and trade. And oftentimes we just take too much risk, and we have massive drawdowns, and we're down 50% in a year. And that's tough to come back from. If you're down, you think about how the numbers work. If you have $10,000 and you go and you are increasing that, okay, let's say it drops to $5,000. So you have a 50% loss. What percent return do you need to get back to whole? Now, to get back to 10,000, I need 100% return. So a 50% loss means I have to get 100% return just to make it back. That's hard to do, and that takes time. So we have to absolutely make sure that this game, our risk management game, is the most important part of what we're doing. Okay, we're going to be right and wrong on the stocks, but the system works pretty well in terms of picking the right stocks at the right time, and then being able to add into those methods consistently. If you're actively trading anyway, you know, if you like to go in and make a trade a day or two or something like that, then why not do it like this, right? If you're trading anyway, you might as well go in. It's simple. It takes you 5 minutes to go in, find the stock, go in, you know, determine. A lot of times in your brokerage account, you can set an allocation on a button to say, I want to buy whatever I'm buying right now is going to be 2% of my cash, or 2% of my account value, or 2.5%. And bam, you click the button, and bam, it determines the shares, and you buy it as a market order, and you're in. It's a really quick process. That's essentially what I do. I use a little Webull account, which I really loved it. I've used it for the last 3 years, and it really has become a really robust little tool, brokerage tool, charting tool. I really like it, and it's really easy to do. I'm actually looking at a few different auto trading systems as well for this methodology with some brokers to say, okay, I want to do the new buy daily, auto trade it, and then it'll auto trade it for you. We're not quite there yet, but it's in the works. It'll probably be another 5 or 6 months down the road. Next summer is kind of what we're shooting for, but I think that methodology, people like it, but it's like, oh, why not? Why, if it's automated, why can't I automate it? And we're working on being able to do that. So that's kind of what we're looking at today. The sell to buy, this is a little slower portfolio, but it's also had some decent winners. Here's a good example, MSTR. This one, this was the signal right here, and this was the sell. So you had a sell, and this is the first buy signal after the sell signal. And all I'm doing is I'm just using this scan right here, sell to buy. Okay, so the sell to buy scan, whatever is the top of the list is the one I'm adding into. GRCL is top of the list today because it's the first buy signal after a sell signal. Okay, right here. And some of these stocks that have been beaten up in this downturn, they may get a run. This is another biotech, could be highly volatile, but again, that the allocation is going to help us manage the risk, the size of the position, so that we're only 2.5%. 2.5%, yes, you got to have a pretty good return, but if you're doing 2.5% across multiple stocks, and one's up 20%, and one's up 4%, one's up 5%, and one's down 2%, and one's down 10%, you get this variation of diversification across these holdings. So really, these are the two strategies we're focusing on. The muscle stock strategy is another one we can use. This one I've done a little bit differently here, but it's typically on this one, I will only add into muscle stocks in an uptrend, in a buy sell ratio of 1 or higher. So when that ticks back up to 1, then you're focused on muscle stocks, only adding them into the portfolio in uptrends. That's a really high octane strategy as well, and we're just not there yet. We just are kind of waiting on some of that, because these are the stocks that run quickly. You can see that we've got a handful in here now. DAKT, this one, keep an eye on this one. This was a new buy yesterday, and it's got a little bit here of a pullback, but it's a nice looking pattern, and it's bouncing off of this momentum zone right here as well. And there's a few that are in there. So let's see what the market ends up giving us. The other thing is, your ETF strategy. You could do the same thing with ETFs, and that is it doesn't make quite as much sense, just because these are, I like the ETF strategy for hedging as well. So you could simply say, okay, in buy sell ratio conditions of 1 or of less than 1. Get my drawing guy out here. Right here, I could say, instead of adding new stocks into a portfolio, I'm simply going to buy inverse ETFs, okay, or 1 or 2 of them, as you're getting a new buy, and maybe it's starting to reverse. There's some really cool ones in here. This uranium one, which is some diversification. We're actually getting this one here, this Bitcoin strategy. These are, I believe this is buying into Bitcoin related stocks. I'm not entirely sure, or if it's a Bitcoin tracking ETF, but there's lots of really just just really cool ETFs that allow you to do a lot of different things. This one we've talked about a lot, this PFIX, which is an interest rate ETF. So this could have been a way to be like, okay, bonds are dropping. How can I profit from that? I can either buy an inverse bond ETF, something that's opposite TLT, or I could buy something like PFIX. And so I'm long interest rates going higher. And so all of the, all the talking and all the stress and all the worry about inflation or about this or about that. There's lots of different vehicles and tools to be able to position yourself and to be able to profit from those events as they're being discussed. And most of the time, this is going to pull all that to the surface. It's going to say, even like uranium, PFIX, muscle stocks will kind of tell you what the current trends are. Interest rates, these are interesting too. We're seeing daily Microsoft and Tesla and a whole bunch of other leveraged. I think that's kind of crazy myself, but it's cool. It's options. It gives us more options to be able to do different things. So Microsoft had a big upturn. It's getting pummeled today, but this basically is just 1.5 times what Microsoft does. Okay, it's making these guys making direction some money because there's fees and everything else associated with that. The other one here to look at is gold. So gold is having a nice run. That's also, I think, going to be a nice sustainable uptrend. Gold in that long-term chart also looks attractive. All right, I'm just going to summarize here and kind of, well, we kind of did. We've got our sectors, which everything is just beat up, and we're kind of waiting for a little confirmation on the markets. Buy-sell ratios are extreme. We talked about bonds, both short-term and long-term bonds, trying to find a little bit of a bid right here, meaning a little bit of buying activity. SHY, which is moving up today so far. TLT, which is not green yet, but it's at least up. It's at least trying to find a bottom. At least it's not sliding anymore, which is what we want. Is what I think what the market ultimately is waiting on to see. That'll do it for today's update. Everyone, I sure appreciate your time and effort, and we'll see you next time. Bye now.